Brian, I've heard about these things called the Irrevocable Life Insurance Trust, or ILITs. Can you explain what those are?
Yeah, we're going to kind of get into the weeds here a little bit.
We are.
Irrevocable life insurance trusts. There's all kinds of different trusts out there. This is a particular kind of trust where you fund it with life insurance policies, as the name suggests. So they can accomplish multiple objectives. One objective might be if you have a taxable estate and you don't want it to grow more because you're worried that the federal government or your state are going to take a lot of your money that you want to go to your heirs. You can get a life insurance policy and put it in a trust and fund it with money that you have now, take it out of your estate, put it into the trust and fund a policy. Over the years as it grows, someday you're going to pass away and that policy is going to pay out. It's going to pay the money to the trust. The trust is not part of your estate, so it avoided the estate tax. The premiums you paid came out of your estate. They avoided it. The growth avoided it. They're tax-free, so you got out of estate tax. Another way you can use them is to fund your heirs generationally. You can put money into that. It's protected in the trust, so instead of giving them money directly, it's going into a trust for their benefit later. So no matter what the income and estate tax rates are in the future, whatever you put into these life insurance trusts outside of your estate is going to be income and estate tax free to your heirs and reduce the amount you would pay to the state or the federal government.
Brian, who is an ILIT best suited for?
Well, you have to qualify for the life insurance, so that's one thing. And you have to feel like you might have a taxable estate. That would be another reason. If you think you're going to have a federally taxable estate, and those amounts are changing, the new administration wants to lower, how much you can give tax-free to your heirs. State of Washington, for instance, has a very low threshold for that, so a lot of people in the state of Washington use ILITs to get money out of their estate that would otherwise be taxable and give it to their heirs instead. Another reason is you just think future tax rates are going to be really high. So if you leave money to your heirs, they're going to pay all kinds of income tax on that, whereas once you put it in the trust, it's not going to be taxable. And so it can be a real safety net for future generations. So no matter what they do, again, to estate taxes, exemption amounts, state or federally, or income tax rates, it's a way to protect that. And it's also a way to protect your heirs from spending the money on things that you don't want to spend it on and having it there within the confines of the trust.
Sounds pretty good, Brian, but what are some of the reasons that someone may not want to use an ILIT?
That's a good question. That's like anything we talk about, there are pros and cons. So the negative to this is once you've put money into an ILIT to buy life insurance for maybe it's on your life for your heirs, you can't get that money back. Once money goes into trust, there's no takebacks. You can't go, oh boy, my son's really ticking me off lately. I'm going to take that money back and not have that there. No, it's gone. You've gifted it. So it will be a gift out of your estate. That's why it avoids the estate tax. If you were allowed to claw it back, it would not avoid estate tax. So these are gifts. Once that money's gone, it's gone. And once it goes into the trust, you can't get it back.
Brian, it sounds like there are a lot of benefits to using an ILIT. Can you give me an example of a client that you've had who has used an ILIT to their advantage?
Yeah, so the ILIT, again, it's funded by the Fixed Index Universal Life. Typically, and if you haven't watched that video, watch it to discover what that's about. And then this is a way to kind of control what happens to the money. Because again, if you gift money to people, they can do whatever they want with it. There are no takebacks. This is a way to gift money to people and still have control over it in the sense that you control how it's dispersed. You can't take it back, it's not that kind of control, but you do control the outcome of it. And so if you want to protect future generations from overspending that money, then you can put it into the trust and it can do its thing that was you wanted it to do, the income and estate tax-free amounts to future generations. And so that's the primary thing about it, why you would do it. I've had examples of people that will set their kids up and they'll start funding fixed index universal life on their kids' health, and the kids will have these amounts funded, money's coming out of their estate, and they know every year that they put $15,000 in their kids' thing, they're saving 20 to 50% in estate taxes. The growth is tax-free, and they love that. That the kids will get that money someday, and they're funding it for each kid, and it's under the annual gift tax exclusion amount, and so there's no gift tax returns to file on these. And so often they're used in that case where I see where we're doing multi-generational planning. So if you have excess cash and you have other generations, this is a great way to do multi-generational planning, especially if you have a taxable estate either in the state that you're in or federally.
Brian, thanks a lot for telling us about ILIT's Irrevocable Life Insurance Trust.